the problem is that as numbers get bigger, it takes more and more to move the needle.
Yeah.
But the upside of that is it's a more liquid network. So Bitcoin in 2025 is more liquid than Bitcoin in 2017. And you know, I think a lot of that money is pretty sticky. So I would generally expect, you know, drawdowns to be controlled. But then upside, if you shoot upward really quickly, you do get a lot of selling pressure from older holders, like people that have been holding longer than are up significantly, either rebalancing or, you know, upgrading their house, like they're, you know, the quote unquote buying the Lambo. You do see some of that cycle. So I think it is healthier not to go straight up and to kind of go over time.
Bitcoin's mid-cycle signals are sparking renewed optimism for a bullish rally, and Lyn Alden's sharp analysis offers key insights into why this could be the case. Bitcoin is no longer just a niche asset. It has grown into a maturing financial ecosystem. As adoption accelerates and market liquidity deepens, its behavior has shifted in ways that reflect its evolution into a truly global asset. Alden explains how Bitcoin in 2025 is fundamentally different from its earlier cycles, such as in 2017. Today, it operates with significantly greater liquidity, a result of growing institutional acceptance and widespread usage. This increased liquidity enhances Bitcoin's market stability, but also brings new layers of complexity. Cycles of profit-taking, rebalancing, and reinvestment are more pronounced, showing a shift from speculative spikes to a more balanced and sustainable growth pattern. While dramatic price surges often dominate headlines, Alden warns they can lead to destabilizing corrections that undermine long-term progress. Instead, Bitcoin's ability to sustain measured growth, supported by its deepening market infrastructure and diverse investor base, is a sign of its maturation. More than just financial milestones, these developments mark Bitcoin's transformation into a trusted vehicle for wealth preservation, changing how individuals and institutions approach the concept of financial security. Alden's insights offer a clear roadmap for understanding Bitcoin's future as it continues to shape the global economy, and why this mid-cycle could be the foundation for its next major rally. Let's watch clips from Lyn Alden's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
The debt ceiling can affect liquidity. And as I covered in a report with Sam Callahan and other work, Bitcoin price actions historically pretty correlated with liquidity. It's not the only correlation, but it's one of the more sizable inputs to Bitcoin price in the intermediate term. And so the debt ceiling, basically ever since roughly World War I, instead of Congress micromanaging every Treasury issuance, they say, look, the Treasury Department can do those details, but you can't go over this limit. And that's different from authorizing spending. This is basically just how they pay for spending that they do authorize with their other bills. It's kind of like whether or not the government's going to pay their previously agreed to bills or not. And for roughly a century, it wasn't really used by one party against another. But ever since the global financial crisis, it's a tool, you know, now we're in this age of more political polarization. It's a tool that can be used largely from the out of power party against the in power party, or at least whoever is president at the time. It can be used against them to extract some degree of negotiation. And if it's not lifted, you get technically the risk of a technical default. In practice, usually at the 11th hour, it's fixed. And we have a fairly small sample size because it's only been used since the global financial crisis. Usually it's used against Republican Congress, against a Democratic president. But that's partially because most of the years after the global financial crisis have been run by a Democratic president. Democrats didn't really use it against Trump in his first term. And we've not really seen like intra-party usage. This, if it's used here, and so far it is a little bit, if it's used here, it would be the first time, at least in modern history, where the Republican Party is using it against the Republican president. And so if they do enforce it and they try to extract concessions, then essentially the Treasury cannot issue net new debt. They can't increase the total debt load. To the extent that some go are due, so they pay out, to existing maturing debt, and they can issue some new debt to kind of offset that, but they can't increase the total amount. And so they have to start taking what they call extraordinary measures. And that's the date that matters for January 21st, because the outgoing Treasury Secretary Yellen and her team estimated that the 21st is when they basically run into the actual debt ceiling and have to start shuffling their books around to keep things operating without issuing new debt. And the part that's relevant is that if this starts going on for weeks and months, they have to start draining their cash balance back into the financial system. So at any given time, the Treasury has a Treasury General account. It's their big checking account at the Fed. There's something like $650 billion in it right now. And if they can't issue debt, but they still have bills to pay, they can start draining their cash balance. And that's how they can keep running things for several more months. The last time this happened was the first half of 2023. And that, ironically, when the TGA is drained, it's actually pretty good for liquidity because all that money is draining back into the financial system. Excess.
Is that almost like QE?
It's kind of like QE, yes. And so they can offset quantitative tightening with that unintentionally. And any excess liquidity from that will probably spill into the reverse repo facility. But yeah, that's basically all pro liquidity. And so that actually can be decent for asset prices. The risk comes, first they have to get past the debt ceiling impasse, but then when they actually go to refill the cash balance is when they could run into liquidity problems. So my base case is that this won't be a protracted one because we've never really seen an intra-party dispute get really protracted like this. But it's not out of the realm of possibility. Trump wanted the debt ceiling resolved before he took office. That didn't happen. And so now he has to solve it in office, but he has the benefit of his own party to work with. The initial point was to not have to micromanage Treasury issuance. So it's a law that made sense a century ago. So before World War I, the U.S. government was simple enough that literally Congress could kind of micromanage Treasury issuance. That eventually got too big, too bureaucratic, too much going on, so they can't micromanage it. They say, okay, Treasury Department, do it. Just don't go over this number. And that's how we've been operating for like a century now. And it doesn't really make sense because it's not about allowing more spending. It's about whether or not you're going to pay the bills that you are already authorized. So Congress, which authorized prior spending, is now authorizing a debt ceiling increase to finance the spending that they've already authorized. That's the part that doesn't really make sense. And that's just basically an historical artifact that just is kind of the way things work. And yeah, it's mostly theater. And technically, if you had a really entrenched argument, you could run that into a technical default. And so it does put some pressure on the president to do things. But like I said, intra-party probably means less pressure, but we'll see.
So do you think they're going to have to dip into the Treasury General account in the sort of short term?
If weeks start going by, yes. There's actually already been a slight dip into it. So their current target is to have 700 to 850 billion in their account. And they dipped under 700 billion. Now, at year end, at the end of every quarter, and especially at the end of the year, there tends to be liquidity strain in the system, like literally the last couple of days of a quarter. It's possible that they dipped it a little bit to kind of boost liquidity for that few day period. I'm not otherwise sure why they dipped below their 700 billion figure. So they're already a little bit dipped. But yeah, basically every week this starts going by, generally that has to start being drained. Now, any given kind of multi-week period, so if you have 2 to 3 weeks, bills go out regularly, debt matures irregularly. So not every week is going to be signal, but as you get into February, March, April, May, if there's no debt ceiling resolution, then we should start to see that cash balance drain.
The debt ceiling debate is more than political theater. It's a financial tightrope with ripple effects on liquidity and markets. Lyn Alden explains that as the U.S. Treasury draws down its cash reserves during a standoff, liquidity temporarily surges, boosting asset prices like Bitcoin. However, the eventual need to replenish funds could tighten liquidity, creating market turbulence. While intra-party disputes are typically brief, this showdown underscores the delicate balance between political decisions and economic stability, with Bitcoin closely tied to the outcome. Bitcoin thrives at the crossroads of liquidity cycles and global monetary policy. Lyn Alden highlights Bitcoin's correlation with liquidity, where domestic policies like quantitative easing and global dollar strength play pivotal roles. Despite global liquidity pressures, optimism surged with pro-crypto developments, including a potential US Bitcoin reserve. On-chain metrics, like market value and long-held coins, indicate a mid-cycle phase. Alden remains bullish, forecasting Bitcoin's resilience and growth over the next 12 to 24 months, amid fiscal dominance and evolving market dynamics. Let's watch more clips from the interview.
There's domestic liquidity and global liquidity. If you focus on domestic liquidity, there's basically a handful of big moving parts that determine what's happening with liquidity. So one is the central bank increasing or decreasing the monetary base. Basically, quantitative easing is pro-liquidity, quantitative tightening is anti-liquidity. Then there's other sources of liquidity. So because they did a ton of excess QE, a lot of excess liquidity was created, even more than the financial system could take. And so a lot of that was stuffed into reverse repos. That's kind of like a black hole of like excess liquidity or a void to kind of put it there temporarily. And as they've done various anti-liquidity options, some of that is actually starting to come back out into the system. It's kind of like a buffer. So that as the reverse repo facility is drained, pro-liquidity, and then the TGA is filling it is negative for liquidity, draining it is positive for liquidity because it goes back into the system. So all those things kind of affect. One way to think of it is that if the government's spending but they're not issuing new bonds to do it, then they're spending money into the system and not really extracting money from the system. That's kind of juicing up the system. On the other hand, if they're borrowing money but they're not spending it yet, they're pulling liquidity out of the system and holding it in this void, their TGA, that they're not recycling back in yet. And so that can tighten financial conditions. The other things are harder to pin down, but it's like credit availability. So are banks tightening loan standards to various businesses and consumers, making it harder to get a loan than they were a quarter ago? Or are they easing their lending standards? They're more optimistic. They're a little bit more relaxed. That affects basically day-to-day liquidity for businesses and people. And of course, interest rates also factor into that as well. And then when we take a step back and look at global liquidity, a really big component there is the strength of the dollar relative to other major currencies. And the reason for that is because around the world, especially in emerging markets, but this is all intertwined globally, you'll have a lot of borrowing in dollars. And it's not even usually the U.S. entities making those loans. Like literally a firm in France could make a loan in dollars to a borrower in Brazil. It's because the dollar is global reserve currency. And the problem is that when the dollar strengthens significantly, all those liabilities basically increase in value relative to all these entities' cash flows. It could be a sovereign entity, it could be a corporate entity, and they start getting squeezed. And if that happens, a lot of these areas with dollar liabilities, not all of them, but a lot of them have dollar assets as well. Now, on average, the world has a lot more dollar assets than dollar liabilities. And so they can start selling dollar assets, could be treasuries, could be stocks, and then getting dollars to service their dollar debts. So if a company in, say, Brazil has a dollar shortage, Brazil, as a sovereign entity, could help it. And it could be selling some of its reserves to get dollars to do that. And so generally, any sort of spike in the dollar strength is pretty negative for liquidity when it happens, at least as one really big variable.
So that's why when, say, the Dixie's going up, the dollar's getting stronger, Bitcoin tends to underperform.
On average, yes. There's other components, but yes, that is generally a pretty big headwind against a lot of assets. And Bitcoin happens to be the one that's probably the most correlated with liquidity of any other asset that I track.
Why do you think then in the last few months the dollar's been doing quite well while Bitcoin has also been doing well? What's different this time?
I think the election outcome is a big difference. So, like I said, it's not the only impact. So it's not been a great few months for global liquidity. But when you have a major election outcome like that, that impacts the industry more than other things. So it basically a strategic Bitcoin reserve went from 0% under if the other administration would have won to some number that Polymarket is trying to guess. We don't know what the chances of a strategic Bitcoin reserve are. Maybe by the time this airs, there'll be an executive order. I don't know. But so as of this moment, we don't know the odds, but they've suddenly increased a lot more than zero. Other kind of pro policies for the industry have also shifted upward. And so all of that had to be kind of priced in. And I think that that was a bigger positive force than what is a fairly small liquidity drain. So the dollar going up was not great for liquidity, but we're talking, single digit % change in global liquidity.
What do you think all of that means for Bitcoin in the next 12 months?
I mean, generally, there's a bunch of variables. So the combination of ongoing fiscal dominance is pretty good for Bitcoin. Tariffs or anything that could reduce liquidity. So tariffs, a dollar spike, that's around the margins negative for Bitcoin. So I would expect probably some of those events happen this year. They're probably not sustained for very long. Kind of negative liquidity is not really, it's hard to sustain for long periods of time given how levered the system is. The policy mix is probably neutral to bullish for Bitcoin. And then when I look at certain on-chain things, like really basic stuff like market value relative to cost basis, or the HODL wave, like what percentage of coins haven't moved in a year and how many of them sold into the bull market, because bull markets are characterized by the market value getting way ahead of the cost basis, and are characterized by some of the older coins that are up 5, 10, 20x selling into the new buyers. So I look at those types of indicators to see, are we stretched here? And both of those still look kind of mid-cycle. Now, cycle structure could change, so there's no guarantee, but most signs to me still point up. 12 months, anything can happen, but if I say 12, 18, 24 months, I'm still pretty bullish on Bitcoin at these levels.
The cryptocurrency market is showcasing a fascinating blend of momentum and caution, as Bitcoin continues to trade between $100,000 and $109,000. Retail on-chain activity for transactions under $10,000 has decreased by 19.3%, suggesting subdued participation despite Bitcoin's strong performance. Google Trends data reveals that searches for Bitcoin and related terms have increased year over year, yet they remain far below the euphoric levels of 2021. Moments of excitement, like the launch of Trump's meme coin, which initially surged to a $15 billion market cap before dropping by 55%, show how brief euphoria drives retail engagement more than sustained rallies. Lyn Alden's analysis helps contextualize these trends within broader macroeconomic dynamics. She emphasizes Bitcoin's correlation with liquidity, explaining how factors like quantitative easing, fiscal dominance, and global dollar strength influence price action. Alden notes that while retail interest might appear restrained, Bitcoin remains strongly linked to liquidity cycles, which play a pivotal role in its intermediate-term performance. She also highlights the mid-cycle structure of Bitcoin's on-chain metrics, which show potential for further growth without being overstretched. Alden's insights point to the resilience and strategic value of Bitcoin amidst these dynamics. She predicts that fiscal policies and liquidity trends will likely maintain a bullish tilt for Bitcoin over the next 12 to 24 months. As Bitcoin evolves into a more liquid and strategically significant asset, these trends underscore its growing role in a world shaped by economic uncertainty and shifting financial priorities. As we wrap up, how do pro-crypto policies, such as a potential US Bitcoin reserve, shape Bitcoin's future adoption? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.